the easiest would be, you know how much we owe you, so just take it and that's it.
Yeah. That's our next phase of AI and IRS integration.
Mm-hmm. Yeah, we'll see.
Welcome to the Physician Sense Podcast, a podcast designed specifically for physicians, offering a breakdown of complex financial topics to help you develop your financial IQ, further your financial journey, and improve your well-being. Whether you're a medical student, resident, fellow, or attending physician, you're sure to learn something new that will benefit your journey. And now, your hosts, Chad Chubb and Tyler Olson.
Welcome to another episode of the Physician Sense Podcast. I am your co-host, Chad Chubb. I'm joined by the one, the only, my financial bestie, as I always call him, Tyler the Olson. You like it?
Chad the Chubb.
That's a fun ring to it.
It does.
When I was in grade school, they would say if you said my name fast enough, it started to sound like ketchup. Chad Chubb, Chad Chubb, Chad Chubb, Chad Chubb.
Hey, pass me the Chad Chubb.
Yeah. See? Has that ring to it.
Yeah.
How are you, my friend?
Doing good. It's chilly. It's quite cold out, and I'm just waiting to see if the ice dams on our roof are going to wreak havoc on our budget for this year, our home maintenance budget.
I know it has been a chilly one in the Northeast. We had some cold days down here in Tampa, too. We did the outdoor hockey game a little bit earlier this year by the time this goes live. And we were like down in the 30s. We had some wind chills down in the 20s. It was a pretty good cold spell for Florida. And there was even flurries on the radar. Some areas reported flurries close to Tampa. Pretty crazy.
Hey, so who is playing that game?
That was my beloved Boston Bruins, who ended up losing in a very questionable referee game, but I won't go there, versus the Tampa Bay Lightning.
Okay. Yeah. So actually, that's funny because a client of mine, he and his wife were at that game. He sent me a picture and he's like, if there's ever a time to have a hockey game in Florida, this is the time.
The joke was the weather gods and the hockey gods definitely made a deal on that one, because the big concern going into that game was how, traditionally, 67 degrees, kind of hard to maintain quality ice outside, but it was a magical night. Even as a Bruins fan, it was tough to see them have a big lead and blow it. But there was a goalie fight. The environment was amazing. The fans were amazing. It was special. So a special cold night in Tampa, to say the least.
Mm-hmm.
This is also a special time for us. Do you know what today is?
Wait, no, tell me.
This is episode 50.
That's awesome. We've had 50 conversations and we haven't killed each other.
We have not killed each other. I think our love has only grown. We're like a young glass of red wine right now. We're just getting better with age.
We even had a couple episodes in person when we could have inflicted physical harm.
That was our chance. And we sat very close to each other. Remember? We had to do that in a hotel room. We were pretty much like literally thigh to thigh, and we still are besties.
Yeah. And
50 is a cool number, but technically we're also just about at the 2-year point. Once we bi-weekly episodes, 26 weeks, right? Coming up on 2 years too. So a lot more to go. It's been a beautiful 50. Looking forward to 50 and many more with you, my friend.
Likewise. This has been fun, and I'm looking forward to. I like this, so let's keep going. We're talking about taxes today, right?
We are concluding our 3-part mini-series from, again, a beautiful text from you, or a beautiful tweet, I should say, from November 2nd, and we've gone through the first 12. Today we get to the finish line. Tax tips 13 through 18. And these mini-series, we just did our mini-series on financial independence, and that series did really well. So I'm very optimistic that this one will have a similar power inside of it. So shall we get started?
Yes, sir. Let's do it.
Number 13. I'll read these as we've done for the last 12 here. Number 13, buying real estate without understanding passive loss limits. Most physicians can't deduct losses unless they qualify as a real estate professional, also sometimes called reps status. That requires strategy and free time to be such a professional, and documentation, the good old rep status. Beautiful, sounds beautiful, but it's not as simple as it sounds.
It's complicated because of the requirements, and when people first hear about the record keeping needs, like where it's like you're supposed to document your participation, I think a lot of doctors don't realize how detailed these need to be, and that, 3 hours to go buy an air filter is not going to cut it. it needs to be actual work. And it's obviously like with couples where, if we're talking about a married couple and one is a practicing physician and the other one either is or does something else and is up for dropping that and becoming a real estate professional, then there's some optionality there. But I think that I don't think that a lot of doctors realize it at the outset. They just see the big headlines about how they could deduct their W-2 income if they get into real estate.
Yeah, and it sounds amazing, and when you actually get it to work in the right ways, it can be a huge win. The best setup we see is what you just noted there, right? You usually have a high earning physician in the household, and then you usually have maybe a stay-at-home parent. Kids are getting older, or maybe in a lower paid occupation, but they also have some type of love for real estate. So that's a pretty good setup. But the other issue we see quite a bit, I'm sure you see this as well, is it's also not as simple as we have one rental property. You need to have enough time to actually get the rep status. And I mean, even there, 2 properties might not be enough. 3 properties might not be enough. You might have to have, a multi-unit in there. But if you can get it to work, it can be really nice. And for those of you who are not familiar with this topic, this is where when you have rental income, you can be earning that income, but the depreciation from the property can offset the tax per se on that. So you could be actually getting paid income, but you're not paying tax on it. One of the most beautiful things here of real estate. But the problem is if you have too much depreciation, I shouldn't say problem, you have too much depreciation, it's not going to be able to offset your regular income unless you get this rep status. And that's the big win here, is if you can actually offset your regular W-2 income. This is like the definition of tax arbitrage. But it's one of those ones where it sounds very sexy. This is like, the clickbait 101 on Instagram these days. It hasn't been as bad, I think, because of the way that the rental real estate has calmed down a little bit with higher rates. But this is one that we get a lot of questions on this, and we kind of walk clients through it on, yes, it sounds great and it can work, but it's not as simple as you buying one row home thinking that, you're going to offset all your W-2 income now.
Yeah. As with all things related to tax planning opportunities, you have to be willing to look at the details and see what it is. I think learning about it is obviously, like, learning is almost always a good idea. It could be a good use of time. I think where I think that physicians need to be cautious is around the cost of such education. Like with our clients, we're certainly educating them, but we're also responsible for doing things with them and for them. And we're accessible on an ongoing basis around real estate or other tax planning activities and all sorts of other stuff, as you all are too. And we get paid for that. But we don't we don't have people come in the door and say, we're going to teach you about real estate. That'll be $5,000. So I'm not saying that it's inherently not worth it, but it would be beneficial to look at these to learn at least this much without it costing you thousands of dollars. Because I've had doctors go down that path and realize oh, this isn't going to work. And they just spent several $1,000s to find out that they can't do anything. So I think it'd be good to learn the bones of it before committing a lot of time and money to education and implementation.
Yeah, no, that's a good one. This is one too where I feel like there's probably half the audience that are very intrigued by this topic, and the half the audience that's like, I'm not going to do it.
Yeah, true.
And we've seen quite a bit too, where one of our clients will buy. Their goal is to get to this, but they buy one property, they see how much work it is, and then they stop at one property. I think either we discussed this offline before, it's been a part of another episode, but it's a lot. It's being a property manager is another job. How many times have we joked about the term passive income? To get to rep status, someone is working pretty much a full-time job in real estate. That's the only way that this works. That's literally the real estate professional, right? That's your job. So just keep that in mind. Beautiful thing when it works, but also requires some education and some steps to get there as well.
Yes, sir.
Next one here, we got 14. One of my favorite topics. Skipping HSA optimization. It's the only triple tax-free account. Most stocks use it like a checking account instead of letting it grow for the retirement healthcare cost. HSA, healthcare savings account, one of my favorite topics, one of my favorite accounts. What do we add to it?
I mean, I think it's really important to start from the point of what a person or family's healthcare needs are. Any conversations I have about HSAs, when people are like, "Oh, I've heard about the HSA that it's like so beneficial, I'd like to take advantage of it." Before we get ahead of ourselves, I think it's important to ascertain what one's personal healthcare usage is, because HSA plans are invariably high deductible and there's no or little copays. You're paying for everything out of pocket through the entire deductible. Obviously, the preventative care visit once a year is an exception, but anything else that comes up, you're going to be paying for. And so some people, they have medication that they need to take regularly and it's expensive. And if you have a copay, then it helps make it a lot more cost effective. And then this triple tax benefit would be fairly moot in that case, because if you opt in for these benefits, but then now you're sacrificing the savings that you would have gotten on a low deductible, high usage plan, that's not very smart. So it's good to start with that. Once you ascertain that you can manage a high deductible plan because you have minimal healthcare needs at the moment, then yeah, absolutely. One thing that I think that people go back and forth on, myself included, is whether to keep the receipts for decades thing. You know what I mean? Like where it's like, you don't have to reimburse yourself right away. You can just keep the receipts, pay cash for the healthcare expenses that you do have, leave the money in the HSA, keep it invested, and then 30 years later, after having been invested, then you can take the reimbursements out tax free. What do you think about that?
Yeah, we always will describe it to my family, but also our clients in, don't save the random trip to Target or CVS, but the big ones you pay out of pocket, a couple $100, couple $1,000, whether that you have a physical file at the house, whether you have a box or online file that you can store those. That's always been our viewpoint on it, is the big ones, store those somewhere. I'm also under the impression I would not be in a rush. This is me personally speaking, not talking to clients. I would also not be in a rush to ever pull money out of my HSA, because I know that I will have enough healthcare cost later in life as I age. I almost think of HSAs for like our generation as the long-term care replacement. Like, we're not going to go buy long-term care insurance. We're just going to have this massive HSA bucket. Maybe I use it for long-term care needs. Maybe I don't. Maybe I die and my wife will get to use it, or maybe, God willing, neither one of us would need it, and it goes to the kids. Not a great inheritance tool, but you catch my thinking there, where it's going to be used one way or another.
Mm-hmm.
So that's why we don't get too carried away. Like, we've never had a client actually go through like a midlife crisis, later in life. And they're like, I'm actually going to use my HSA to buy a Ferrari. We joke about it, but we've never seen it yet. So I wouldn't get too carried away. I'd like to think most physicians will be in a spot where they wouldn't have to tap into that for a random expense or a random cruise, even something exciting. So I think there's a benefit to the big bills, but I wouldn't get carried away.
Mm-hmm. Yeah, that was my thought too. I think the likelihood of those costs being absorbed by later in life expenses is highly likely. So it's like a return on hassle situation. Be like, nah, forget about it.
Yeah. Again, I'm sure there are really good reasons to do it, but I just keep thinking, I mean, maybe it's because you and I will look at like the cost of long-term care, or if anyone's ever gone through long-term care with a loved one, you see the cost of it. Even if you have $2 million in your HSA, you could still have a really prolonged bad long-term care need and go right through that. So that's how I've always thought of it. Maybe that'll change over time, but HSAs are a great tool for many reasons. I think we've had other episodes and blog posts and things of that nature on the topic as well.
Yeah. What's up next? Oh yeah. W-4s, right? So exciting.
Number 15 from Mr. Olson: not updating W-4s after major life changes, marriage, kids, job change. All of these change your tax situation. Fail to update equals surprise tax bill. I love the W-4. I am actually amazed by how many neglect the W-4.
Why do you love it?
I feel like it's just something that you can. Well, I don't love the actual form. I like the control of the W-4.
Right.
I'm actually we have an accounting firm that helps a lot of our clients, so they have their own system. But if a client's working with someone else that's not linked to them, I'm a big fan of whatever your W-4 currently says. I won't mess with it, but I'll increase that additional withholdings because for physicians usually it's going up, it's not going down. So I like the control of that. And I like to try to dial in. We do W-4 updates for pretty much all of our clients if they need it throughout the year and they're off. But I like the W-4. I think it's a form that doesn't get enough love for what it can actually do, especially for those of you with either large refunds or large tax bills. The W-4 is your key to fixing that.
Yeah, I do like the control factor. At first, it sounded like you just really like the form.
No, I don't like the form. I wish there was an easier way just to say withhold this number. I don't want to check any boxes. Just use this number. That would be much easier in my opinion.
The easiest would be, you know how much we owe you, so just take it, and that's it.
Yeah, that's our next phase of AI and IRS integration.
Mm-hmm. Yeah, we'll see. Yeah, it's good to be proactive. A couple I know, they're planning to get married later in the year. That's an important point. Like if you have someone that gets married in November, and some people, they know many, many months in advance that they're getting married, and then you can plan ahead and you can adjust your W-4 for January, because if being married before the end of the year, it's all going to apply to the whole year's worth of income. And so that, it's important to update it as if you already are married. Now, of course, if you're single and then you get married, there's a lot of scenarios where you end up having more taxes withheld on, filing single. So maybe you'd end up with a surprise refund, right? But that's still, I like to minimize that too, just because you don't want to be hanging out there with tons of extra cash. I know there's folks who really, really like the massive refund surprise, but and that's fine if that's you. But yeah, I think it's something to be proactive about. Like another thing too is, if another scenario I've seen is when you're working for an employer, especially in academia, and then suddenly it splits and now you're going to have two employers. They're like another entity, before you were working for the university and now you're working for the university and the medical school. And it's or the physicians group. And so you're getting 2-3 paychecks. And now the W-4s need to be updated that are aware of the other income. Because one W-4 is only informed by itself, by its own income. And you have to tell it. It's kind of like AI, it doesn't know anything. It's stupid without input, right? And we have to manually get those things in, and you got to know how to make sure that it's understood. And sometimes it's a little bit of touch and go.
Mm-hmm. Yeah, we'll tell clients all the time. It's going to take, hey, we're probably not going to be perfectly dialed in. After your next tax return, we're probably going to have to adjust a little bit more. We should be pretty darn close by that point. And then there could be another one we have to adjust it a little bit. And I think the hard part with physicians is what you noted, one example, 3 different pays, but then they also have uneven, right? They have their regular pay, but then they'll get their RVU bonuses. They could be quarterly bonuses, they could be annual bonuses. Those could throw it off. Then they had 1099 income. They weren't paying quarterly taxes. So then we're trying to make it up through a W-4. There's a lot of moving parts. I think if you're, a teacher or a nurse or, some type of truly steady income, the W-4 is probably once and done. You're probably good. Besides the major life events, maybe tweaking a little bit here or there. But because physicians not only have high income, they can have uneven income at high levels, the W-4 can take more adjustments consistently, right? Maybe a few years, you got to make a few updates and you're good for a little bit, and then a few more updates. So the W-4 is just one where, I would say it's either a good financial planner or a good accountant that actually truly enjoys the W-4 to try to get that number organized. Again, large refunds are also just as bad as large tax bills. Clearly, large refunds, we're not worried as much about penalties and interest and some of those things. But W-4, I love it. Not the actual form, but the overall idea of what the W-4 can do.
Get a room.
Me and my W-4. Me and my side form. But You see those like funny memes where like it's like guys hanging out and they're like, my wife thinks I'm cheating, but it's like it'd be like us actually having a podcast instead of talking about personal finance and
being like W4s. Yeah.
What's he doing up in that office up there? Oh, just talking about W4s. All right. Number 7. Oh, no, 16. 16. Oh, a good one here. Roth. All right. Number 16, overvaluing Roth post-tax retirement contributions, plan contributions. If you're in the 37% bracket, you might be better off deferring taxes now. Tax diversification is greater than Roth obsession. Ooh, this one's juicy.
Yes, sir. Yeah, people love the Roth. This is a tough one. And there's a lot of factors. It's not, it isn't just the tax bracket, it's also your state. Like any of our clients that are in California who are like, oh, I want to do the mega backdoor Roth. And I'm kind of like, yeah, and if you're a W-2 employee that happens to have access to it, then that tends to be a good idea because you max out on the pre-tax side. You can't put any more on the pre-tax anyway. And it's not like you've got some other retirement plan options like a cash balance plan in that setting in most cases. And maybe you've got a 457B and a 401A that you can contribute to. And then you could ratchet up the pre-tax on that side and then do what you can through the mega backdoor Roth in your 401k or 403B plan. But for private practice docs who are in high state income tax states who do have access to like a cash balance plan, or they're like self-employed. Like we have several clients that are in that situation where they can get a cash balance plan and it works with a 401k. When the actuaries are doing their numbers, the goal here is to defer taxes because you're in such a high income tax bracket. But then of course you can't be doing the mega backdoor Roth because you can only contribute so much to the 401k side if you're doing the cash balance plan. So it's a tough one because Roth gets a lot of love. Tax-free growth sounds really great. But if your investments are getting cut at the knees because your income taxes are so high, you're not getting as much in to the account to grow. And, what's your average tax rate going to be in retirement? If you're savvy or you're working with a savvy financial planner in retirement, they're going to be helping to manage that tax bracket at that point too. So, anyway, and doing like Roth conversions in those lower income years, post, during retirement, there's a lot of detail here. I just think that it's one of those things I get asked these questions because it sounds like, oh, I should do it because Roth is great. And I'm like, I don't know because there's so much detail to know. So maybe.
Yeah. No, I kind of always make the joke, we wouldn't have as much gray hair if we knew future tax rates. That'd make this a lot easier. But I do agree. I even say 35, 37% tax bracket, you likely should be doing pre-tax. And state definitely has a big effect here. It's not for everyone. That's not a blanket statement. But you said it beautifully, right? I try to yell this from the rooftops. You will have a very good chance between the day that you retire and before those RMDs start to do something called Roth conversions. And you will have an opportunity to fill up those smaller tax brackets, those lower tax brackets, ideally much lower than 35 or 37%. The other hard part of that is we don't know what future tax rates are going to be. So if tax rate where you are today and where tax rates are when you retire and for the rest of your life, for that example, just keep in mind, if tax rates don't change, neither one of these options is better, right? The tax number is the same, whether you do pre-tax or Roth, which is another kind of misconception in there. You need some type of movement. And again, over decades, we're going to have lots of movements. I mean, heck, over 4 to 8 years, you're going to have lots of movements. But for those higher tax brackets, we try to always do everything we can pre-tax. This is why I love the backdoor Roth. Backdoor Roth doesn't waste anything. I know it's not super sexy. You're $7,000, $7,500 per year, but it still is blowing up Roth numbers while you're not wasting anything pre-tax. So this is a juicy topic, as I joked about there. And there is a lot of details here. It's not as simple as, you can't come up to Tyler in a conference and say, hey, should I do Roth or pre-tax? You essentially need a full financial plan to even give fair guidance. And even that, the guidance probably isn't right because it's a cloudy crystal ball, right? We don't know what tax rates are, growth rates are. A lot of stuff's happening in there. But don't get overly obsessed with the Roth. And I'm saying that I said I love the W4. my real side boo is actually the Roth. That's what I love the most.
Yeah. Amen.
All right, let's transfer over to number 17. Coming down the home stretch here. Number 17 from Tyler. Not coordinating with a planner before year end. Tax season is for reporting, not strategy. If your EA/CPA only talks with you in March, you are already too late. And they're likely not going to talk to you in March. So yes, you are too late. I added the last part.
Yes, sir. And I mean, this is mainly about the difference between tax filing and tax planning. And a lot of people, they think that they're paying for tax planning. And so they think that things are proactive and that there's action being taken. But in most cases, it is a matter of it's just reacting to the data and inputting it. That was the main education point on that. Is just like if you want to try to manage tax liability, it's something that needs to be done before you earn the income or while you're earning the income in the tax year when there's still time to do things. You know what I mean?
Yeah. Yeah. And well said. I mean, it's one of those ones where it's where we say having a good financial planner is likely going to be your biggest advocate for tax planning. Most accountants are just going to file your taxes. And if you're paying just, H&R Block, even a local CPA, EA, couple $100 is not going to get you deep tax planning, right? It's going to let them file your taxes. And the time to reach out is not February, March, April. It's, heck, I mean, you can even go up until October, even when they're on all the extensions, past October is a good time to reach out and do the strategy part of it. Work on the W-4, talk about how could you have lowered your tax bill. I feel like I'm defending accountants here. I feel like they get put in a bad spot where they're like, my accountant doesn't do anything for me. And it's the main thing they're supposed to do is file your taxes, especially for the fees that most of us are paying. The tax planning side either needs to come separately, probably at some type of hourly rate from the accountant if they do that, and or having a good financial planner. But I agree, coming in for that proactive, lower my tax bill in March and April, even if it's probably very hard to do it for the past year. Some things you can still do, but even for the next year, that's a really hard time for them. They're 20-hour days just trying to get these things filed. You're not going to get great tax planning in a proactive sense in that world right there.
Yeah. Yeah. One other thing I'll add is that if you paid $500 for tax filing, don't think that paying $1,000 now means you have a proactive, ongoing tax planner under your belt. Accountants are they're gonna charge what they decide, but from my perspective, they're complexity dependent. If you're paying a few $100s more, that does not give you ongoing throughout the year access to a tax advisor. And it maybe you don't need it. There's like some doctors are like, I'm just W-2. There's not a whole lot to do. And you're right. Maybe you just need tax filing and you've learned what you need to learn about pre-tax contributions to your retirement accounts, HSAs, like we talked about. And there's not a whole lot more to it. You don't have quarterly tax payments. Things are simple. Then yeah, you don't need to pay for tax planning. But others that they have their own business, practice, 1099 income, side work. There's stuff to do. So don't miss these opportunities if that's you.
Yeah. And I don't know what you've seen in the pricing world out there, but all of a sudden it seems like the new going rate for a pretty much very, I don't want to say very basic, but a normal tax return is starting to get close to about $1,000 for filing. So to your point, even if the person that was charging you $300 is retiring and now you're paying $1,000, you're likely not getting like quarterly check-in calls, updating the W-4, checking that year-end pay stub. That's likely the going cost for a lot of tax returns now. If anything, ideally, you're just getting quicker response times, but you're still getting tax filing for the bulk of that $1,000. Maybe a quick little note at the end, like, hey, throw some money into I'm going to say SEP because that seems to be what they usually default. I like the Solo K better. I know we've discussed this. But yes, you're not going to get a lot in March and April.
Yep.
All right. Last one, my friend. Number 18 on a beautiful 3-part series. Keeping zero documentation. No receipts equals no deductions. The IRS doesn't care that you're busy saving lives. They want proof. Not that you save lives, but of the actual deductions you're trying to take on your taxes.
Mm-hmm. Yeah, they appreciate that you're saving lives, or they should. But they don't say, well, you were saving lives, so it's okay. We don't need any receipts. Yeah, I mean, anyone who's been through an audit knows that things are, they're going to be like, we need receipts. Where are the receipts? You have to prove your innocence in an audit. There's no like they don't have to prove wrongdoing. You have to prove right doing. That's not a word, but you know what I mean. So you gotta have a folder. Like what I do is I have, just like a physical file and then a digital file for each tax year, and just take pictures, upload them, keep it organized, and that way, if the audit ever comes, you've got everything. And just be like, here, share a link to the drive. Here's the folder. Make your life easier. It's like little bits of maintenance throughout the years that can really, really pay off in terms of stress relief.
Especially for any of you that are business owners, 1099 is included there. Not to say that my system is perfect. I keep a little, like a 12 pocket accordion type folder, and every month is a folder. Put them in there. Towards the end of the year, I'll kind of make sure they all match up to what was in QuickBooks. Put a big paperclip on those, put them in a physical file, save those files, I usually keep them for around 7 years. And then we'll go through a shred event, but document everything. And things that are, the one that I see mismatched quite a bit is if you are paying a child, make sure you're documenting the work that they're doing. Whether that's, I actually had my oldest son help me shred some old tax files and some old papers that we had from before. And I actually took pictures of him shredding, because I'm like, in today's world, the IRS probably doesn't even believe that people shred papers anymore. They're like, who even has paper anymore? So just like,
well, they do.
Yeah, they have a lot of papers. Yeah, they should be exposed of that. And just, again, we'll note everything. So just those little things, document. I know a lot of you are thinking I'm never going to get audited, and that likely will hold true. But if you ever are audited and you didn't document anything, or you documented here and there, it's going to be really painful. And you're probably going to have not only a tax bill, you're going to have some penalties and interest, because usually it's a couple years have passed, right, since that audit's coming in. So document everything. You'll thank yourself later. Just creates good habits. And to Tyler's point, whether that's an old school accordion file for the actual physical stuff that you get, but today a lot of stuff is physical. You get a PDF of it, throw it in a file for 25, 26, 27, whatever year it pertains to, lock it in there. But it's a heck of a list, my friend. I love when you do threads. I think your threads are very good. You have a good way of mixing complex topics with easy to understand notes. So another very good thread, my friend. I enjoyed this one. Any closing thoughts on this thread?
Well, this is leaning into my bias, but with all these things, err towards simplicity. There comes a point when there's no blood in that turnip. So, it's okay to stop. Tax planning is beneficial until it becomes a lot of time hassle and complexity. So just be mindful of that limitation. But, there's a lot to learn here, and it was a good conversation.
Yeah. It's almost like the idea of like work-life balance, but also planning life balance. How much time and effort do you want to put in to save, a little bit of extra taxes? Was it worth it compared to something else? And I couldn't agree more with that. Tax planning is a part of every financial plan, but you can also, with any topic in life, you can take it too far and you're starting to lose some of that juice per se, as you noted. So happy 50th, my friend. Looking forward to 50 more and many more after that. But as always, I'll catch you on the next one here.
Sounds good, man.
All right. Thanks, Tyler.
This information is for general purposes only. This information is not intended to be a substitute for specific professional, financial, or tax advice, as individual concerns vary. Please see a financial professional, CPA, and/or an attorney in regards to your own individual situation. Wealth Heals Advisory Services and Financial Planning offered through Vicus Capital Inc., a federally registered investment advisor. Olson Consulting LLC, offering advisory services and financial planning, is a state registered investment advisor.